cases. There has been increased amounts of testing, of course, which will lower that proportion, but we've also expanded to asymptomatic levels of testing as well in the states. So, again, you have to know who are you testing in your local environments in order to fully understand the epidemiology and the estimates of the infection rate in your local jurisdiction.
So how much have we tested to understand what percentage of the population have had COVID-19? And if they show antibodies, whether they're protected against recatching COVID-19?
Great question. So the antibody studies are quite mixed. There are some really, really strong studies and some really, really poor studies. One of the strongest, we've seen two large studies that came out of California, one in Santa Clara County and one in Los Angeles. Those are relatively convenient samples. They're not random samples of the population. They are not exceptionally robust methodological approaches. We have also seen a study out of Indiana, which does take a much more rigorous and methodologically robust approach. So when we look at the estimates that are available to us, first we must understand, is this good science? Is it good population representative data? And the one out of Indiana really comes the closest. The question that politicians and decision makers are trying to decide is, do I want quick and easy and possibly dirty data, or do I want the right answer? And the right answer, unfortunately, takes much longer and takes also a lot more money to obtain an actually true population representative estimate. The final thing I would make here is that our serology tests have failed us on multiple points. And so right now, we're now coming to grips that we've got a really strong serology test, and we now know the parameters, and we can choose the right type of test based on our budget and our environment.
Jason, thank you so much, as always. Jason Farley there of Johns Hopkins. And be sure to check out VRUS Go on the Bloomberg for the latest information. Tune in every day for our exclusive conversation with Johns Hopkins experts, for also an inside look at battling COVID-19. Up next, more Bloomberg surveillance. This is Bloomberg.
pandemic has done, it has exacerbated every division we had.
The choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City, for our audience worldwide, good morning. Good morning. This is Bloomberg Surveillance with equity futures deeply negative. We're live on Bloomberg TV and radio alongside Tom Keene. I'm Jonathan Ferro, together with Lisa Abramowitz. Tom Keene, it is the data nobody wanted to see. This cyclical reopening rotation in this market taking a pause as the data across several states in America begins to speak to an increase in infections.
John, this is the first day, I'll say, in 2-3 weeks where we really shift from recovering East Coast cities. What's fascinating, John, is Axios moments ago features New Mexico and Oregon, where others are featuring, say, Arizona and Texas. It is a state here, but it sums up, and I don't buy the second wave stuff, John. It just sums up to an expanded pandemic.
It is a moment for humility, Tom Keene, real humility. And I think the Federal Reserve Chairman went some way to projecting that yesterday. Not a moment to project confidence when you can't justify it. We are not thinking about raising interest rates. We are not even thinking about raising interest rates. I think he was pretty clear in yesterday's news conference. They're not going to do a whole lot in terms of tightening anytime soon, Tom.
Absolutely extraordinary. John, I sort of blew it yesterday. You know I'm not a fan of the dot plot, and I never looked at DOTS on the Bloomberg. And folks, all you need to know is it looks like an old line hockey stick, a vintage hockey stick from my ute. It looks like a CCM 5-stripe. It's flat out to 2022. And then miraculously, John, interest rates elevate somewhere out there longer term. I don't buy it for a minute.
Yeah, the long-term dot was a bit of a head-scratcher for me as well, Tom. We'll try and talk about that a little bit later. Lisa Abramowitz, we've got to talk about the data too. A blowout payrolls report on Friday. The data this morning, I think everyone asking the same question, will the data this morning validate the optimism fueled by that huge upside surprise this past Friday?
Yeah, and the data that you're talking about is at 8:30 a.m. Wall Street time. We're talking about continuing and initial jobless claims in the United States. A lot of people expecting another 1.5 or more million jobs lost in the past week in terms of claims filed. Really, the continuing claims will be the focus, with an expectation that they will continue to tick downward, perhaps adding some confirmation to Friday's report. Also, what I am watching today, we've got PPI data, producer price index data coming out, and this follows yesterday showing no inflation whatsoever. Be very interesting to see whether we're seeing any of that, particularly in the food and how much that offsets some of the deflation elsewhere. And then at 4 p.m. Wall Street time, President Trump is going to be in Dallas, Texas, speaking at a roundtable about the economy. We are interested to hear whether he says anything about infrastructure spending. We know he has dabbled in that. Also, we are hearing that he may give some kind of proposal to police reform. Interesting, though, John, to your point about the virus cases, that he is going to be in Texas, the state that opened first and is now seeing record hospitalizations for that region, raising some questions about how he will address that.
Some campaign rallies coming on the agenda as well in the next several months too. Lisa Abramowitz alongside Tom Keene, together with myself, Jonathan Ferro. This is Bloomberg Surveillance. As we get you set up for the morning ahead, we have more labour market data at 8:30 Eastern. That data around about 90 minutes away, as Lisa explained. Today, though, we have to start with the deteriorating situation in the pandemic. Stability for about a month, and now in several states, things begin to break down the wrong way. I want to start this morning's conversation with Alessio De Longis. He joins us from Invesco. Alessio, as always, we will not ask our guests to be epidemiologists if they are not epidemiologists. What I'm interested in from an investor's perspective this morning is not just how the pandemic data changes, but how investor attitudes changes to those changes in the data. Can you walk me through how you think investors will respond to the latest increase in infections we're seeing across several states?
Well, this beginning of a second wave is quite concerning, because I think all of us as investors would have expected a second wave, but would have expected it maybe in the fall. So this second wave starting, especially here in the US, so early on in the summer, is a bit counterintuitive, and really a sign that reopening is a very delicate situation. I think this puts a spotlight also on the reopening process in Europe, we had successful reopening, so to speak, in Asia, with the due exceptions, right? In South Korea, for example, we had a concerning rise. But in Asia, broadly speaking, the second waves were contained rather quickly. The implications for investors are meaningful, because the rotation between defensive and cyclicals, or say from growth to value, or from large caps to small caps, were really, really large themes that were taking place in the last couple of weeks.
Alessio, there is a belief that the bar to another lockdown is much, much higher, because so many of these states have now built out healthcare capacity. The track and trace is far forward than it was, say, several months ago. What's your response to that?
Well, it is natural to assume that over the last 3-4 months, we have gotten more prepared with respect to testing, with respect to amount of capacity in the healthcare system to handle this. I think it's reasonable to assume that the second wave will not caught us as unprepared as we were the first time. So in my mind, the investment strategy should be focused on, as we have argued before, on actually harvesting more credit premia across the credit spectrum in high yield, in investment grade, as these spaces tend to rely more on the amount of monetary stimulus and credit stimulus that we're seeing, which continues. Well, equities will suffer, to your point earlier about the impact on cyclical, equities will suffer more from the disappointment or lack of momentum in earnings that we're likely to see in the second half of the year.
Alessio, if the V-shaped recovery died yesterday with Chairman Powell's persistent comments, how does the equity market adjust to that? I mean, if it's another wall of worry, doesn't that benefit stocks? Well, so maybe not to the same extent, to be honest, because the first wave since the Fed and fiscal stimulus, not only the Fed, but globally, was really about multiples expansion, right? Stocks rose, and there was a V-shaped recovery in stocks that was entirely driven by the price component and multiples expansion. Earnings, as we know, are still in a very, very difficult situations and continue to fall. From this point on, to maintain that recovery in stocks, we need to see earnings growth at the cost even multiples compression or multiples staying flat. But it's critical here in this second phase of potential stocks rally to see the support from earnings growth. While for credit, as we were arguing earlier, being senior in claims, just being able to avoid a serious round of defaults and having the backstop of the Federal Reserve, that should allow for credit premia to be harvested by investors.
Alessio, let's pick up on that and build. I know that you've been recommending taking credit risk, or you have been taking credit risk within the high yield space over investment grade in order to capture that extra risk premia. I'm trying to understand, though, the Fed backstopping valuations to an extent, but not necessarily preventing companies from going bankrupt, as we see the bankruptcy rates rising to the highest level since 2009. So how do you draw this distinction, and how big of a risk is it that you're still going to see this wave of bankruptcies escalate?
It is a serious risk, and these are risky credits in some parts of the high yield market. From our perspective as asset allocators, the reminder is always to be very diversified in your credit portfolios in order to avoid those idiosyncrasies. For more nimble investors, one valid approach this early on into the recovery is to invest in defensive fixed income factors, such as quality high yield credit, staying down into the curve spectrum, into the maturity spectrum, staying sub 5 years on both investment grade and high yield, and focusing on for the same ratings cohorts on attractive quality and attractive spreads. So when you look at the fixed income universe, you can draw an analogy as you have in equities, focusing on quality and low volatility factors rather than value and up in the risk spectrum in credit.
Alessio, very quickly here, does tech still lead? I mean, with all the adjustments, the grimness that we heard from Chairman Powell, is that revenue build at the tech's the be-all and end-all of the equity market?
Tech still leads in the sense that it's where quality is today. is where in a low growth world, and in a world where more than ever a globalized and diversified source of revenue growth will be important in order to diversify the economic risk, tech still leads. And it will provide a little bit less cyclicality, especially at these inflection points where we're beginning to question the sustainability of that V shape.
Alessio, always great to catch up with you, sir. Alessio De Longis there of Invesco on this market as that cyclical reopening rotation starts to take a pause over the last couple of days. The market, just a subtle shift over the last several days, Tom. The Nasdaq outperforming the small caps, tech starting to make a comeback, treasury yields picking up a bit, yields lower, curve flatter. All over the last couple of days, we just take a bit of a pause from some of that optimism, maybe even exuberance of the previous week.
Yes, a real nuance. You know, some can call it profit taking, but you just really wonder from here. I was really taken, John, yesterday by the persistent grimness from the chairman of the New York Times led with that, Janice Smilak. But it was really interesting, the wall of worry that he put up. Isn't that good, John Farrow, for stocks?
Do we really need the chairman of the Fed to tell us that a V-shaped recovery was unlikely? Pretty much every single economist, Tom, that I speak to on a daily basis says the same thing. What did the chairman say yesterday that was actually new, fresh, that changed anything?
Oh, I thought McKee's last question, I mean, I don't know if McKee will be invited back to the press conference next time, but I thought McKee's rude question on asset bubbles, and the chairman gave a very responsible answer. I thought he did great.
I would say that comms at the Federal Reserve were very strategic, putting Mike McKee at the end of the news conference so that afterwards they could do a quick question and answer and then run out the door and close out the news conference. In your market right now, we break down near session lows of 59 points on the S&P 500, down by 1.84%. Coming up a little bit later, Afsan Ebechelos on this market as we start to break down just a little bit this Thursday morning. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. A second wave of coronavirus cases is emerging in the US. Texas reported its highest one-day total since the pandemic emerged, and a month into its reopening, Florida reported 8,500 new cases. That's the most of any 7-day period. Still, experts say that surges cannot be linked directly to reopenings from the coronavirus pandemic. Powell told reporters the Fed's not even thinking about raising interest rates. Policymakers kept the key rate near zero. Almost all officials forecast keeping it there through 2022. President Trump's slipping polls may make it more difficult for the Republicans to keep control of the Senate. The coronavirus crisis and the mass protests against police brutality have hurt the president's popularity. The question is whether it will bring down Republican incumbents with him. The president met with Senate Majority Leader Mitch McConnell yesterday. Bloomberg learned the two discussed the Senate races. And the European Union reportedly will file antitrust charges against Amazon. According to Dow Jones, the case has to do with the way the world's largest online retailer treats third-party sellers. It would be the latest step in the EU's almost 2-year investigation. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm a big environmentalist. I believe strongly in taking care of our environment.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg Commodity Indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered.
consumer customer focusing jobs. Now we're going to start seeing the management roles being laid off, and we're seeing some anecdotal evidence of that. What are you looking for signs of how deep that will be?
Right. So a couple of things. I think in the near term, we can continue to watch the claims numbers, and that is quite interesting when you see continuing claims that we think may be coming down, but initial claims that are staying very elevated, really numbers that we've never seen before. And that indicates that there's just a lot of churn going on in the sense that, yes, there's some rehiring going on, but there's also continued layoffs that are going on. That the net number, I think, is positive in terms of more people are being hired now than are being laid off. But what we're looking for then is in the next jobs report, when you look at the industry composition of those jobs, you see, for instance, a lot of jobs coming back at restaurants. And we think we'll see that. We think we'll still be well below where we were before the COVID disruption, but we will be coming back. Maybe in other industries, though, like you were saying, maybe management jobs, maybe services that support those functions, you may see some continued job loss in those areas.
Andrew, I got to go back to what you just said about yield curve control. I don't buy it for a minute. That thud you just heard, folks, was John B. Taylor out at Stanford falling out of his bed listening in the early morning to this conversation. Andrew, look, it's rules and discretion. We've clearly abandoned rules, and we have a new form of discretion, and with immense respect for Catherine Mann and her shop, there's no way you can be discreet about jawboning yield curve control. You either do it or you don't. How are they going to affect yield curve control in the 2 or 3 year space?
So it's very difficult for any central bank. We've seen some examples, but it's very difficult for any central bank to completely tie their hands to a policy path. And I would say that's particularly difficult in an environment where there's so much uncertainty around the forecast. Remember that 2022 forecast, you have some Fed officials, 4.5% unemployment, other Fed officials, 12% unemployment. So how can you today know where the correct level of 2 year yields is? I mean, I agree with you, Tom. It's very, very difficult to commit to a yield level target.
Andrew, I can't think of any frontline economist like the esteemed Catherine Mann who would say, throw out the dot plot. Should we throw out the dot plot? I mean, it's ridiculous, the dispersion of guesstimates out 24 months. I mean, John Farrow can't even figure out what AC Milan's going to do next year, let alone 2023.
I think it certainly emphasizes the difficulties around having a dot plot. And we've seen that a few times over the past years. Well, the Fed has had the dot plot that in scenarios where there's heightened uncertainty, sometimes the last thing you want to do is give the impression of more certainty than there is. And that's actually something Chair Powell talked about a lot when he first became Fed chair, the idea that the communications of the Fed should be moving towards recognizing that uncertainty. Now, I think what's changed, and the reason you're hearing less about that, is because right now the Fed wants us to be certain that they are supporting the economy. And even if that means expressing a little bit more certainty than probably really anyone has on 2022, that's an acceptable cost to do everything you can to support the economy right now.
Andrew Hollenhorst of Citi, always great to catch up with you, mate. 7:40 Eastern, good morning. Tom Keene, fired up. Tom, these are usually the things that I get fired up about. This drives you insane. This is your button now. I just need to push it every morning. Yield curve control. Yield curve control.
John, we have been so honored with the guests we've had. Gary Stern was lights out yesterday on the Fed show with Scarlet Fu. I mean, Dr. Stern was just absolutely fabulous. Blinder, the honor of having Olivier Blanchard, Raghu Rajan with us yesterday. None of these people are buying this smoke and mirrors. It's theoretically, John, hogwash. I mean, can I say that on radio?
Well, what I would say, Tom, of course, you can say whatever you like, Tom. What I would say back, though, is what's new about this? Forward guidance has been to anchor the front end for a long time. They've been doing that for a long time. What's the difference by adding, say, yield curve control on top of that to say this is where the front end's going to be? I agree with you. Far more controversial if they go out down to 10s. But I don't think anyone thinks they're going to do that.
I just don't think they can. Rick Adana was great on this a couple weeks ago. I just don't know how they go out 2 years, 3 years, given the set of natural disasters we have led by this renewed pandemic. They just shorten it up, and they should be going quarter to quarter, a la what Greenspan used to do.
You would like to see, can you imagine what would happen to this market if we had a Greenspan Fed back? I know a lot of people, the market purists out there, might like that. We'd have a very different set of financial conditions, I imagine, given the guidance we've had through the last couple of months. From New York City this morning, good morning to you all. Equity futures down 61. We're down 1.9% on the S&P 500. This is Bloomberg.
More than 1.5 million Americans filed for unemployment benefits last week. That's more than 7 times the pre-pandemic average. Meanwhile, the total number of claiming benefits is projected to have declined to 20 million, and that's more than 11 times the level prior to the pandemic. President Trump will resume his campaign rallies June 19th in Tulsa, Oklahoma. It's a date and place that have meaning for African Americans. Juneteenth is a commemoration of the end of slavery, and Tulsa is the site of one of the worst massacres of black people by whites in the U.S. The Trump campaign says the president has built a record of success for black Americans. President Trump will keep the names of Confederate leaders on some of the biggest military bases in the U.S. That puts an end to Pentagon deliberations over ending tributes to treasonous soldiers. The namesakes of Fort Hood, Fort Bragg, and other facilities were rebel generals. Global news 24 hours a day on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
Look, I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg. Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I definitely think we are going to need another bipartisan legislation to put more money into the economy. I think, as we've said, we don't want to rush into that because we want to be both careful at this point in seeing how the money is in the economy. A lot of the money is still not in it. And two, I think we need to be much more targeted at this point.
Secretary Mnuchin, the Treasury Secretary, on the path ahead for fiscal policy from New York this morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz, getting you in shape for the opening bow this Thursday morning. 1 hour and around about 42 minutes away from that cash open, with equity futures at session lows, down 64 points on the S&P 500. We are negative around about 2 percentage points. In the bond market, a shape of things as follows for you for Treasuries. Your 10-year yield coming in around about 3 basis points at the moment. On a 10-year, 0.7% if we round things out, but down 1%. In cable, down around about 0.6%. And to round things out in the commodity market, let's talk about what's happening with crude right now, with crude coming down by 4 percentage points to $37 and around about 93 cents. Tom Keene, that's the market. I want to reflect on Michael McKee's question from yesterday in the news conference. A remarkable exchange with Michael McKee and the Federal Reserve Chairman, Jay Powell. Mike asked a couple of things about financial stability and about inequality as well. It was a quick answer, and then he got out of there quickly, real fast. But I can tell you that was the question that a lot of people wanted to be heard asked in this news conference. And I was really disappointed that it came at the end, Tom, because I wanted to hear people follow up, push him more, because I do not believe that it is as binary as the Federal Reserve leaves us to believe. They can do more targeted things. It is not just about the blunt tool of interest rates. We've seen that with the credit programs they've launched over the last month or so.
Yeah, there's no question about that. I would say that, importantly, John, to be fair to Chairman Powell, who I think gets better and better, folks, at these press conferences. Remember, I'm forced to listen to every word of it because I'm on air with Scarlet Fu. And he is getting better and better at them. He had 2 elegant statements within the conference on the pandemic, and John, I believe near the end, on the challenges this nation faces in protest. But with that, I thought Michael McKee ended the press conference with a discussion of asset inflation and then really addressing the inequalities, which were very extraordinary. As John and Lisa have mentioned, there is a change in the air, and it's not funny. There has been good news on the pandemic over the last number of days. A trend improved, and that is abruptly reversed in the last 2 or 3 days as the pandemic spreads across this nation and spreads out of control in so many developing economies. Howard Koh is a doctor. He is a physician out of Yale University. And yes, he had public service with Barack Obama in the Department of Health. But far more, and the people of the Boston community know this, he has been a true star of medicine in a very medical community. How much so? He's done the rarest of rare things in medicine. He's thrown out the first pitch at Fenway Park, and we're thrilled that Dr. Koh could join us this morning on the pandemic. Dr. Koh, you are so esteemed in dermatology, in oncology, a broad set of internal medicine. Do you buy the idea of a second wave, or is it just a spread of the first wave of this virus?
Well, on March 13th, the president declared a national emergency for our country. And unfortunately, the latest data indicate that that emergency is far from over. We're seeing rising cases and hospitalizations in the West, in the South, in the Southeast, in rural parts of our country. Rising hospitalizations in particular concern all of us because if hospitals are overwhelmed, patients can't get the care they need and deserve. And as we enter the summer and businesses want to reopen, everybody wants to have the confidence that this pandemic is behind us and we can't say that at all. So we have to follow all these trends very, very carefully, especially as we move into the fall and beyond.
So, Dr. Ko, I want to draw a distinction between a second wave that stems from people actually in a reopening economy getting back out there and a second wave resulting from policy that perhaps isn't securing against a resurgence in the virus. Is what we're seeing right now in Texas and Arizona an inevitable outcome to the reopening of the economy?
Well, Lisa, we're very concerned because we know what works to prevent infections and prevent death, and that is the best public health practices possible. Some states have followed that and watched the indicators and the trends very, very closely as they've opened up. Others have proceeded, despite the fact that cases and hospitalizations and deaths have been increasing. So this is a combination of a biologic threat, but also policy issues that need to be coordinated better on the federal level. Lisa, we have right now 50 states going in 50 different directions. We need a one country, one government approach to this pandemic going forward.
Dr. Ko, a lot of people saying there is little appetite to review some of these shutdowns that we saw throughout the nation going forward just because of the economic hit. What other policy tools do you see being effective that could potentially reduce the number of cases and the potential for a serious second wave going forward without shutting down the economy again?
So we have to track the trends very closely. That's the number one message here. We have to watch those cases, hospitalizations, deaths. We have to target our efforts to high-risk communities. We know, for example, the communities of color have taken a real disproportionate burden of the deaths and suffering to date. We have to make sure that the testing and the contact tracing and the preparations for PPE for the fall and beyond have to be coordinated at the highest level. These are the things we have to be paying attention to as one country, not 50 states going forward.
Howard Cohen, Harvard professor. Doctor, fantastic to catch up with you this morning, sir. Thank you very much for your input as we get you in shape for the market open this Thursday morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Brammitz. This is Bloomberg Surveillance live on Bloomberg TV and radio. Session lows in the equity market, Tom Keene. S&P 500 futures down 69, call it 70 points now. We're down by 2.2%.
Yeah, to be clear, for those waking up across this nation, we've been grinding away lower steps just to see if that gives way and flattens further.
Yields down, curve flatter. That's the story right now. Let's whip through the price action for you, starting with the bond market, with your treasury market nicely bid. Yields lower, not just on the day, but lower, much lower on the week as well, down around about 20 basis points on a week so far. This Thursday, we're down another 3. We chin about 70 basis points. And in foreign exchange, here's the story for you. The dollar makes a little bit of a comeback, chipping away at the pound cable, coming down by 0.7%. From New York, up next, much more. As the wave of infection starts to increase and confidence breaks down just a little bit after a huge cyclical rally of the last several weeks. From New York this morning, good morning. This is Bloomberg Surveillance.
Choice between lives and livelihoods is a false dilemma. The health and the economy go hand in hand.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
all-time low, 2.23% all-in yield to borrow at a time when their leverage ratios are picking up and their potential profits are coming down. In the high-yield space, you have seen a little bit of a sell-off, but still, you're seeing a real demand there, and this sets up a conundrum, Tom. If you have the Federal Reserve underpinning these massive markets, what is the argument against risk, even as you see all of these headwinds facing the economy?
Well, on June 11th, Lisa Abramowitz and Jonathan Ferro, we reset off this Fed meeting. As I mentioned yesterday, maybe we're thinking about the Fed meeting of January 27th, 2021. We will have to see. We welcome all of you on Bloomberg Television and Bloomberg Radio, coast to coast and worldwide. This is our simulcast. And what we've been doing is trying to have conversation with good guests. I get critical notes saying, why are you so short term? So let's not go short term right now. Let's go long term. Shani Beslos is with Rock Creek, but that barely describes her interesting career of teaching international economics at Oxford and then moving on to a storied career at JP Morgan. We usually see her in Davos, and we are thrilled that Ms. Beslos could join us this morning. Shani, for long-term investors, how do you shift? How do you recalibrate over the last 3 months and even trying to look 3 years forward?
Tom, a lot changed, obviously, in March, and the institutional investors, though, have not been behaving the same way we saw with the euphoric retail investors. Institutional investors have been looking sort of, as you said, behind the numbers that we've been seeing in the short term and being much more cautious, whether it was with the rebalancings between the last few months or looking forward into new opportunities. I think if you look at most portfolios, you'll see a little bit more cash still in institutional portfolios, but also looking potentially for some distressed opportunities and not jumping in those areas too fast. In terms of the big topics that institutional investors are looking at, which is sort of the 60-40 portfolio or the 70-30 portfolio of equities versus bonds, there's a lot of discussion going on whether you can get the returns you need in the bond markets, especially given what we continue to hear from the Fed.
Well, but Ashfani, this is so important. And I'm going to ask you this, and it's something I would ask somebody doing market forecasting at any given firm. But I think from an institutional standpoint, it really matters. Is dividend growth the new yield?
You know, dividend yield, obviously, some people are thinking of it as the new yield. I don't think that way myself. But also, I think the very big topic, Tom, that we need to be looking at is the way markets are looking at dividends and returns and earnings has been a little bit over the top over the last few weeks. And I think when we look at potential earnings and the impact it might have on dividends looking forward into 2021, I don't think that the earnings that the market had assumed are going to actually crystallize. And I think maybe that was the reason you started seeing the impact of Jay Powell's speech yesterday. He wasn't saying anything really new, but people started realizing that there is a connection between the economy and the markets, which they've been ignoring over the last month or so.
Afsana, you brought up the 60-40 split in the portfolio. I want to talk about the bond side of things. There are a lot of people asking the question what role Treasuries plays in a portfolio out 2020 through the next several years. They don't offer me the income they used to offer me, and they may not offer me that support in a risk-off environment. Afsana, how are you thinking about that issue at the moment?
You know, what you may need to do is actually look at hedging a part of your portfolio versus allocating 30 or 40% in the fixed income area, or finding other things to put in that category. You also see people actually gravitating more to equities, not because the earnings will be so high, but because on a relative basis, you will be doing better. And then within that, you've seen a reaction of some to increase allocations to emerging markets, even in the recent past. Commodities is another area people are looking at. While there are different views on inflation, and forces that might push certain commodities up, as like food and energy, of course, is on a much slower track. I think investors are looking more and more towards where can they find yield. And certainly, as you said, fixed income is not going to be where they expected to get the returns that we have had, particularly in the last 5 or 6 years.
Policies, while propping up markets, will curb innovation and investment going forward. And this is really the focus of your current firm and what you're looking for. How much are you seeing evidence of this, that the perpetuation of zombie companies that basically would have failed if it hadn't been for the Federal Reserve policies, that is leading to a crimping of innovation that you're seeing in real time?
So what is really interesting, Alisa, is that at the same time as all the negative trends that you've been talking about have been going on in the last year or two, and that has continued. So while we do have this issue in the more traditional economy of zombie companies, as you mentioned, and then the other side of it is the mega size of companies. So let's say we have close to 40% of our economy now is in the mega companies. Similarly, if you look globally, in China, for example, that number is more than 50%. You have that trend going on at the same time as a lot of new companies are getting born. And our portfolio had a lot in health, education, and clean energy, financial inclusion. And all of those were really in more innovative small companies.
Afternoon, Beschloss. Always fantastic to catch up with you. We're down 68 on the S&P 500 and off by 2.16%. The data will be absolutely key this morning at 8:30 Eastern. So in around about 18, call it 19 minutes from now, we will have initial jobless claims and continuing claims as well. This data, Tom, follows a blowout payrolls report that caught a lot of people very off guard. And what we're looking for in around about 20 minutes is confirmation potentially. Let's see if we get any validation of that optimism that we fueled on Friday.
Yeah, it can cut either way, but I've been completely remiss on this, John. You're absolutely right. This is a huge deal, folks, coming out here at 8:30. I'm going to call it in 18 minutes as well. John, the question that I did not get to Dr. Beschloss on is overarching this free lunch of low interest rates forever is what does it do to the actuarial assumption? I mean, I'm never going to retire. I get that. That's what the math says. But, John, I really wonder how we set up a sub 4% pension assumption and what that does to investment. I honestly, I never framed it. I never thought of it. And yet, John, it's here right now.
You're going to struggle, and it's a bigger struggle in Europe at the moment. And this is only one of the big issues of the low-rate policy, Tom. The other issue we have to talk about is the future of capitalism as well. We've discussed this many, many times. The Fed had to do what it had to do. We understand that. This is not a criticism of the Fed's response per se. They had to build a bridge to the other side to make sure this economy did not fall off a cliff. But you can also acknowledge there will be consequences, and not just on the things that you described, Tom, but also in capitalism more generally. Jim Bianco of Bianco Research was brilliant on this in the last 24 hours. The underpinnings of capitalism. What happens if you don't allow the capital to flow away from the bad businesses and to the more productive ones? What does that economy look like in the future, Tom?
And I know Lisa was putting out a Torsten Slok chart on zombie companies, and you really wonder if, John, we can get to a point where it's almost zombie nations if we don't clear out those markets. John?
We'll talk about it a whole lot more through the morning. From New York City this morning, good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro, together with Lisa Abramowitz. This is Bloomberg Surveillance, and we are live on Bloomberg TV and on Bloomberg Radio. That economic data around about 17 minutes away, with equity futures session lows down 71 points on the S&P 500, negative 2.2%. This is Bloomberg.
the curve while the economy starts to kind of shake itself out. And as we've seen today, we're seeing a bit of a risk adjustment as, people take a little bit of a breather after a pretty spectacular run in most markets. And I think at this particular point in time, it is still a good idea to sort of incrementally move yourself out the risk spectrum. Yields are very low. Cash yields are zero effectively, and maintaining income is going to be an increase at the end of 2022. That means the reach for yield for any saver, for any investor, is going to be pretty significant. And Tom, you and I've been on the show for many years. We've discussed this. Been very successful at reliquefying markets, but it was a stark reminder that the outlook is very unclear, and they've increased credit availability. They've allowed reasonably healthy borrowers to access capital markets. But credit availability, it might, this yesterday, expect a long
seas, even though there is the high degree of...
In the higher quality companies, we're talking times going ahead. As you go down they have very limited borrowing needs. So those companies are good opportunities, but they're few and far between.
Hey, George, we've got to leave it there. Send our best to the team, won't you? George Bory of Wells Fargo. Lisa Brown is just waiting for the day that someone comes on this program, Tom, and says they're long triple.
What are the triple C's doing
right?
Right?
Radio. This is Bloomberg.
In this week, American men and women. Some stores
with exposure across 23 traded commodities.
As well, the number that really rated
too far too quickly, and
go to next week's claims and on, of course, in trade and monetary authorities, and of course,
started a year ago, a little over a year ago. What they're thinking, what are the open issues? Where's
much better than expected jobs report. I'm trying to get a sense from.
We have multiple sources of data, and in this case, it's really helpful to have that. I often think of the economy as a little bit like a medical patient. The survey, they call it the census household. The right number is the 30 million. Feeling a lot more comfortable that we're on the right track as it is.
Just joining us on our simulcast on Bloomberg Television and Bloomberg 93 on SPX and the Dow. We're not down to negative 1,000 points, but we were a negative 900 points moments ago, just under 26,000. First comes off your Stanford PhD.
The medical analogy is really helpful here because a mathematical rule is not going to serve the public well at this point. That works, reasonably well. They can do it. Mickey Levy and Mike Border and I have just written a new paper. It's out as a Hoover paper. It'll be out on Monday as the NPR working paper. I think it's also out as a Cato working paper. It's all over the web now if you want to look for it. We show how the Federal Reserve could start producing a set of alternative scenarios and then start explaining what they would do. I think that would help a lot. I was a student of John Taylor. I admire very much the emphasis he and many others have made over the years. If the Federal Reserve wants to be effective in serving the public, promoting maximum employment price stability, it needs to be transparent and systematic. And so that's a critical part of its being effective in serving the public.
Andrew Levin of Dartmouth. Andrew, fantastic to catch up with you this morning. Thanks for joining us. Looking at the market right now, Tom Keene, equities breaking down 82 points on the S&P 500. This morning was really important. Would the data validate the optimism that payrolls Friday fueled? We can look back at the data this morning in the last 10 minutes and we can say no. The economic improvement that people got excited by over the last week, will they continue to have that in the coming weeks? And on the healthcare side of things, Tom, that's the extra layer here, the breakdown, a more fragile pandemic backdrop in the last week or so relative to the stability of the last month.
Yeah, and I don't negate, John, the pandemic update. I mean, this percolated, folks, over the weekend, barely in the zeitgeist. Monday, Tuesday, there it was yesterday. And John, with a vengeance, the pandemic shifts into our economics, our finance, and our investment.
Much more still to come on this program with equities breaking down, going into the cash open. This off the back of a huge rally over the last several weeks. In fact, the last 2 months, we break down just a little bit more. Equities off by 81, down 2.5% on the S&P 500. In the bond market, a shape of things as follows for you. In treasuries, yields come down 4 basis points to 0.68, approaching 1% last Friday. We come all the way back in again, down around about 20 basis points on the week so far. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The US labour market focus today shifts back to job losses. Economists estimate that new total number claiming benefits is projected to have declined to 20 million, and that's even more than the 11 times the level prior to the pandemic. President Trump will resume his campaign rallies June 19th in Tulsa, Oklahoma. It's a date and place that have meaning for African Americans. Juneteenth is a commemoration of the end of slavery, and Tulsa is the site of one of the worst. President Trump will keep the names of Confederate leaders over ending tributes to treasonous sort of a quarantine rule for incoming travelers. Heathrow will first seek voluntary departures after agreeing on a severance plan with unions. The airport had previously warned that the quarantine could lead. And on Quick Take by Bloomberg, powered by more than 20.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation, and diversify your stock. Suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the market. True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented, widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity.
There's probably they want to put the economy back to work, but people are reluctant to do more than they have.
Morning, equity futures session lows down 2.6% and negative 83 points. Live on Bloomberg TV later with Laurie Calvasina of RBC on this equity market as that value reopen rotation breaks down in the last couple of days.
Oh, certainly a big pullback, John Farrow, and what we see in the equity markets.
is supported, invested, and modernized.
Amy, we're talking about infrastructure, which may be in the future when the government gets together with some sort of infrastructure bill to help stimulate growth and do some of these major projects. But in the here and now, we're reopening economies. This week, New York City reopening, and there's a question of what the fate of the United States' major cities will be coming out of this pandemic, given the fact that the spread has been fastest in some of these areas. How concerned are you about the death of the modern city as we know it and sort of the dwindling in population that a lot of people are calling for?
Well, first of all, I think we have to remind people that this pandemic is impacting everyone, no matter what kind of community you live in. In fact, the fastest growth in new cases are not in the big cities, but they're in the suburbs, they're in the smaller cities and the rural areas. So the pandemic actually has no borders. So when I hear questions about what is the future of the city in a post-COVID world, there's an assumption that density puts you at high risk. Yet the reality is that the risk of infection is true no matter where you live. And in the long run, what we've seen is that cities will have continued to rise over the centuries. And the knowledge economy, the global economy continues to reward places with a high density of talent, of amenities, top-tier research in universities, global airports, and other innovative firms. So I don't see that changing, but only accelerating in the years to come. But that said, I do think for high-cost cities like New York, like the Bay Area, there are real questions about whether one can afford to live in a superstar city without a job, right, or with economic uncertainty. You know, Facebook and Twitter, as you know, has announced that some of their employees can now telework permanently. And that may spur some workers to jump at the opportunity to move to more affordable cities in the heartland, which to me is actually really great for those cities and still good for the economy overall.
Emily, thank you so much for the Brookings Institution. Well, we're going to have to leave it there, Dr. Lee. Thank you so much for joining us. Thank you for being with us today with the Brookings Institution Metropolitan Policy Program. There's any number of things going on right now. First of all, I do want to note that the 10-year yield deteriorates at a 0.67 level. That gets your attention. It was as much as 0.91, 0.92 2 cups of coffee ago. We've seen a real yield compression here with flatter yield curve. I'm watching the 2-year very carefully. That is not given way. In the equity markets, futures negative 82, Dow futures were over negative 900, right now negative 885, and really most germane to the markets right now, the VIX up 4.5 points. If you don't understand that, that's a huge VIX move, 32.08 on the VIX, and that'll be a careful monitoring this morning as well. The president just out now tweeting on the protesters. I'm sure that'll be a theme for David Weston as he speaks to the Speaker of the House at noon. This is Bloomberg. Good morning.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Consistency is more important than volatility.
There's very likely to be a decoupling between the United States and China.
I think the reality is this is highly unusual.
This is a really good example of the intersection of business and government.
Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Arizona?
I think it's a combination of both. I think Kaylee used a great term, evaluation reality check. Our numbers show us extended on both this year's numbers and next year's numbers, and frankly, we think next year's numbers are too high. But one of our concerns about this market is that even though we've been on this ferocious upswing since March 23rd, and really since the second half of May, it has felt very fragile. It has been very news flow driven. We got very good news on the vaccines and reopening in the second half of May, which really helped fuel that last big move that we had. And guess what? We are getting concerning data coming out about a second wave of the virus. Today, we're also seeing that not all economic data is going to come in and surprise to the upside, as it seemed to have been doing the last couple weeks. So I think it's a combination of just valuations made us vulnerable to bad news, and bad news that the market cares about has been hitting. So it's a little bit of a imperfect storm here.
Laurie, when you look at the pandemic data at the moment, what are you dialed in on? The stability on the headline number, or the disparity beneath at a state-to-state level?
So one thing that we've been tracking on my team, and we've been doing this for a while now, is just looking not so much at the overall statistics, but looking at how the New York region, so Connecticut, New York, New Jersey, have been trending in terms of new cases versus the rest of the country. And it's sort of X that particular region. And it's been pretty clear to me for a while that the decline in the overall data, sort of that improvement in the national data, has been driven by improvement right where we're sitting, John, and that we've been worried that you would see sort of a second wave hit in other parts of the country, and that seems to be what's happening now. Now, that's not to say it's necessarily going to be out of control. There's a lot of uncertainty here, and like you, I'm not an epidemiologist, but I do know that consistently markets have said they wanted to see a decline in the number of new cases for this market to get stability. We were having that for a while. Now you're starting to see some trouble pop up.
Let's talk about areas of vulnerability at the moment and reflect on the outperformance we've had and where that outperformance has come from. Small caps over large caps, value over growth, international over the United States. As you look at those things right now, the performance through the last month or so, Laurie, where's vulnerable?
So, one of the things we haven't really been inclined to chase has been the value trade. And I'll clarify and say I'm neutral growth versus value on a 6 to 12 month view. But I've really been fighting back against this idea that now is time to jump on the value bandwagon. And I say that as someone who's a value investor at heart, so it's sort of painful for me to say that. But when you look at the components of what has been leading that value charge, it's been things like energy, it's been things like financials. And I've really doubted the sustainability of that financials outperformance in particular, just because of this idea that interest rates are going to stay low for a very long time. I really took away from Powell's press conference yesterday that that's exactly what we're facing. I think he also gave a very sobering look at the economy. So something else I've told investors is what waits us on the other side of this initial rebound. I think it's going to be more of a sluggish economic growth backdrop. Low rates do not favor financials, so therefore they cannot favor value. And if we're looking into the sort of a longer term sluggish economic growth backdrop, that favors secular growers, as much as I hate to say it. So I've told people, if you want to chase something that's been running, chase the small caps. They're at historic valuations versus large. But I've really been pushing back against this idea of just chasing the value trade.
Within value, Laurie, let's just distinguish between a couple of things. I'm in a decent position to gauge where the consensus lies just based on how many people come on this program and what they like to talk about. So many people have talked about being long the financials. I hear less about the industrials. You're fantastic at looking where the flow is going, where the positioning is. What does it look like in the industrials at the moment?
So in terms of industrials, that's the one piece of the value trade I do actually like. And our thesis has been it's just as cheap as financials. It's not dependent on higher interest rates the same way that the financials are. So you don't need interest rates to move up to sort of get that catalyst. These companies have great balance sheets. They're managing their margins very closely. And then if you think about sort of how this society is going to pull itself together post-pandemic, one thing we've talked about a lot is we're going to get back to work a lot faster than we're going to get back to having fun. And so that favors things like industrials over things like consumer, for example. I find that when I talk to clients, it doesn't seem to be that consensus, but they don't really fight against the logic either. I think that financials, frankly, are just ripping, or they have been up until the last few days. Hedge funds have been deeply, deeply underweight that sector, so they felt the pressure to chase there. And I think that's why people are suddenly talking about that space again. But I find on industrials, the views are just pretty balanced there.
Well, the banks are getting absolutely hammered this morning off the back of
companies are spending a lot of money to get through this, and I don't think that all those costs are suddenly just going to go away. Yes, they're good at managing costs, but the idea that things are just going to go back even on the profitability side and the margin side and the cost side to where they were, again, it just doesn't pass the smell test.
Laurie, great to catch up with you. Thank the family for letting us borrow you for 10 minutes. Laurie Calvert-Cedarn, my best to you and yours from RBC on this equity market with futures session lows going into the opening bell. 20 minutes away from the cash open this Thursday morning. From New York, good morning to you all. We're down by 82 points and off by 2.6%. Next up on this program, reacting to Chairman Powell and a Fed news conference, we'll catch up with Nathan Sheets of PGIM. That's next on Bloomberg TV.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We want the markets to be working, and we're not looking to a particular level. I think our principal focus, though, is on the state of the economy and on the labor market and on inflation. Really, it's about getting the labor market back and getting it in shape. That's been our major focus. We're supposed to be pursuing maximum employment and stable prices, and that's what we're pursuing. We're tightly focused on our real economy goals, and again, we're not focused on moving asset prices in a particular direction at all. It's just we want markets to be working.
Fed Chair Jay Powell, in reaction to a Michael McKee fastball at the end of the news conference in the last 24 hours, pleased to say that Michael McKee, our very own Bloomberg economics editor, is with us right now. Mike, were you satisfied with the answer you got at the very end of that news conference?
Not really, John, because the issue still remains. Now, of course, it's a really tough position for Jay Powell to be in. He can't talk down the market or we would have a crash. Now, wait a minute. What's happening today? The issue is, and it's hard to put, maybe today just sort of sums it all up. But if you look at the chart for the S&P 500 going back to 1995, you can see the bubbles that popped back in around 2000 with the tech bubble and then, of course, the housing bubble. And look at the run up that we've had and then look at the drop because of COVID on the extreme right side and how quick that rebound has been. And then today you get this big drop off based on what? Some fear that maybe there's another round of COVID coming. We knew that. So the possibility is you could have a bubble pop anything could happen. There's so many risks out there, and the Fed is kind of out over its skis on this. But as Powell said, what choice do they have? And here's the problem that the Fed faces. They're in a situation where Congress stepped up once and now has stepped to the sidelines. The Fed's the only game in town. People are looking to them. So what more can Jay Powell said except we're going to stay on the job?
Mike, I think for us all, one thing the Fed did do well, and perhaps rightly so as well in that news conference yesterday, was not project confidence where it isn't justified. Real humility about the data. And you and I have talked about this already this morning. Let's reflect on it once again. The data we got 45 minutes ago, trying to reconcile that with the exuberance of a huge upside payroll surprise on Friday. Reconciling the data points is pretty difficult right now, Mike.
Well, it is. And basically what Jay Powell said, and economists would agree, is that you never make policy based on 1 month's numbers. The jobs report last Friday was much better than people thought. But the Fed's view, and most people's view, is that that may be a one-off. We're going to see a lot of people go back to work as the economies open up and restaurants open up and retail stores open up. But then there are going to be a lot of jobs that have disappeared and jobs that don't make it. Restaurants that reopen, but because of capacity constraints can't make money, come off of the unemployment rolls. So the Fed is looking at this as a long-term project. They're dismissing last week's numbers. You look at the jobless claims numbers, and we just had the graph up there. 10 weeks of declines, and we're still at 1.5 million. So there are still a lot of people out of work, and it isn't going to be a problem that is solved quickly. Look at the dispersion of forecast chart that the Fed put out yesterday for unemployment. Very, very wide. Nobody on the Fed really has a clue either.
Michael McKee, the data not validating the exuberance of the last week or so. Mike, appreciate your time and appreciate the work as well going into that news conference in the last 24 hours. Looking at this market, we break down session lows down 80 points on the S&P 500, negative 2.5% going into the opening bell. Here's the take from Nathan Sheets of PGIM, the chief economist over there. Critically for markets, the Fed sees inflation remaining below target through the end of 2022, and accordingly, the Fed funds rate near zero through at least that period. These were forecasts, not concrete commitments, but they were nevertheless sufficient to support a rally in the bond market. Nathan Sheets joins us now. Nathan, always great to catch up with you, sir. Let me ask something I asked someone a little bit earlier this morning. What did you learn yesterday that you didn't know at 1:59 Eastern going into the decision?
I think the answer to that is I learned very little from the Fed's meeting and from the press conference. This was much more of a stand-pat Federal Reserve than many were expecting. Now, the markets responded favorably. The bond market, I should say, responded favorably. Obviously, the equity market is responding differently to it because the Fed opened up a little bit and shared some of its thinking as to the future, and the Fed remains very cautious on the economy. The Fed is deeply worried about inflation and where inflation is headed. And given all of that, it expects to keep rates at zero for quite some time. But that was already embedded in Fed communication and in the very powerful policy response that it's put in place.
Nathan, the idea that they were going to provide any kind of outlook with any conviction about where the trajectory of this recovery would go, I find just completely ridiculous. We've had one big payrolls report, and nothing else really validates that huge upside surprise that we had last Friday. And from the point of frustration, Nathan, I just wonder from your perspective how difficult it is right now to establish the trajectory of the recovery as we reopen this economy.
So the uncertainties in every dimension here, be it the economy or health or political or geopolitical, are all enormous. Now, that said, I think that the forecast that the Fed provided for GDP growth, which I would characterize as a kind of gradual U-shaped recovery, where we have a contraction this year, but probably some pickup during the second half, and then gradually returning to 2019 Q4 levels of GDP next year and in early 2022. I think that U-shape provides a reasonable benchmark for us to calibrate our thinking. And given all of this uncertainty, could the economy perform better and get a little bit more of a V? That's kind of what people were thinking last Friday when we got the strong payrolls. On the other hand, this morning, the tone is a little more risk off, a little bit more worried about the virus again. Could it be worse than that U-shape that the Fed has in its forecast? Absolutely. But I think that there's much uncertainty, but this U-shaped recovery kind of threads the needle in terms of giving us a structure to base our thinking.
Your base case right now, your framework for investing in the year to come, what is it? Low inflation, low growth, low rates? Is there anything beyond that?
That has got to frame the very core of it, that inflation is going to stay low for a long time. We had an inflation problem before COVID. Now it's going to be even more severe. That will drive low rates. And as a result of all of this, growth is not going to be very dynamic. And when you put that together, I think it's a good environment for credit, and probably over the long run for equities as well. This is an environment where people are going to be reaching for yield. And I think it does raise some of the financial stability questions that Michael McKee was emphasizing. But the Fed really has, at the end of the day, one serious tool, and it already has two targets with the unemployment rate and inflation. And it's very hard for it simultaneously to control asset prices.
Well, I just wonder if the one serious tool now is no longer rates, it's the balance sheet, Nathan. The idea that it was just a blunt tool of interest rates is no longer true, is it?
Well, you can frame it. Is it the balance sheet or is it rates? I think at this stage, rates are pretty much off the table. So if you want to frame policy as how big does the Federal Reserve's balance sheet go and how long does it stay there, that probably is a more informative way to look at it. But from either dimension, rates are going to stay at zero for the indefinite future. I would say for years and years. And in that context, we are going to see ongoing balance sheet growth, ongoing asset purchases, and it's really anybody's guess how big this balance sheet will ultimately get.
Nathan Sheets of PGIM. Nathan, fantastic to get your insight. My best to the whole of the team over at PGIM. Some brilliant work over the last few years, and particularly for many of you, I'm sure, over the last few months. In this equity market right now, we're down 74 points to the S&P 500, just a little bounce off a session low. Nathan, the second guest I've spoken to this morning, talking about long being equities, not because they're long the economy, but because they are long financial repression and the reach for yield. Much more still to come on that theme from New York this morning. On the other side, we'll be catching up with you and getting you some of the calls from the analyst community this morning. Your morning calls up next. This is Bloomberg. Just a little bounce off session lows, 5 minutes away from the opening bell in New York this morning. Good morning to you all. Your Thursday morning price action futures down 73 on the S&P 500 and negative 2.3%. That's the price action. Here are some of the morning calls from the analyst community this morning. We begin first up with KeyBank downgrading Starbucks to sector weight after the coffee giant warned about the impact from the coronavirus pandemic. The analysts now seeing a less robust recovery to upcoming earnings and profits. Next up, Bernstein downgrading General General Mills to underperform with a $50 price target. The analyst citing slowing sales growth with limited upside remaining from the economy reopening. And your third and final call, several calls this morning on Apple, including HSBC, upgrading Apple to a hold with a $295 price target. The analyst expecting a busy second half of the year with 4 new iPhones debuting and a successful launch of its 5G model. More still to come on big tech, as the story of the last few weeks has been a rotation away from growth and towards value. We flipped back in the last couple of days. The opening bell up next, futures negative. This is Bloomberg.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Small caps over large caps, value over growth, international over the United States. The story of the previous few weeks. We're hitting the brakes and slamming it into reverse. Equity futures down by around about 2.3%, off by 70 odd points on the S&P 500. We undo some of the reopening rotation of the last several weeks, over the last couple of days. In the bond market, Treasuries bid yields lower by 5 basis points on a 10-year, nicely, comfortably through 70 basis points now at 0.67%. And in foreign exchange, as this session grows older, the dollar growing a little bit stronger. The Swissy and the yen is where your outperformance is. That is where it is expected to be. A very intuitive risk-off Thursday morning. Let's get over to the market desk now and get you some more price action, get you some movers. We can do that with Bloomberg's Taylor Riggs.
John, it was so interesting, as you alluded to, the minute that the narrative changes just slightly, how quickly these big outperforming stocks can really sell off. Come and take a look at this. Some of the big outperformers, as you've alluded to in the last few weeks, Carnival, Delta, even retail names like Macy's, all getting hit this morning. And I want to spend a moment just on Wells Fargo here, because yesterday they sold off 9%. Today they're off an additional 8%. This is after they forecasted higher loan loss provisions. Betsy Gracek of Morgan Stanley is lowering her price target to $27 a share and lowering her dividend forecast for the bank as well. One thing that is not underperforming, if you come and take a look at this chart that I'm showing inside my terminal, the big John are just getting bigger. Apple, Tesla, Amazon, Microsoft, Facebook, all of these stocks touched new highs yesterday, and that FANG index is still 33% above the 200-day moving average. That means that RSI reading on the bottom of the screen is still well below a 74, typically a big oversold indicator. It is also the big outperformer today, even on the downside. If you flip up the board, John, if this sell-off continues, sort of alluding to the theme that we've been talking about, that some of the biggest winners this quarter could be some of the biggest losers. You think it's autos, it's energy, it's retailers, all of those very cyclical sectors that might not do well if people really do get concerned about a new wave of viruses. John.
Taylor Riggs, thank you very much. 2 minutes into this session, equities decline. We're down by 2.5% on the S&P 500. The Nasdaq negative 2.1%. Just a little bit of outperformance on the Nasdaq. It's all relative, but I emphasize the word little here. We are down, and we are down hard at the open this